This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, nononsenseforex.com, and podcast players everywhere. Episode 204 is brought to us by Blueberry Markets. You can trade just about everything nowadays on Blueberry Markets, and you can do it on MT4, MT5, or TradingView. They have all three now. Now, there's other platforms out there where you can trade a lot of things, but what makes Blueberry especially unique is the customer service aspect. Most of these other places do not prioritize customer service, and it shows. You don't really need great customer service most of the time, but there will come a time where you will, and that's where it really matters. And if you click my affiliate link, you will get your very own customer service rep assigned to you. So to do that, go down below, click the Blueberry link in the description, in the show notes. That takes you to the blog. My affiliate link should be at the top and the bottom of that blog. And get yourself signed up. This does not apply to people inside the United States, unfortunately. But this is not Blueberry's fault. They would love to have you. Do not blame Blueberry. Blame your government. It is the 10-Minute Contrarian Podcast, and it is Q&A time, boys and girls. We have not done this in a while. We should do this more often, actually, because I like it because I don't have to write notes. I can just read the questions. But what I did is, because I know that I go over a lot of things, but there still could be lingering questions out there that I'm just not really aware of. And maybe not everybody goes to the YouTube comments section and asks these questions. So I went to the No Nonsense Forex Discord forum. We have an investing section there, and we have one forum called the Buy and Hold Forum. And I said, okay, guys, ask away. And the only reason I would not answer your question is for two reasons. One, if your question is actually going to be a future episode. Biggest rule in podcast land, never cannibalize future episodes if you care at all about the longevity of your podcast. And then two is if it's not an investing question. A lot of times when I do this, somebody tries to sneak a trading question in there, and no. That is what the Discord forum is for nowadays. Now, you might be saying, VP, you have a Discord forum? Yes, I do. It's like 30,000 people large. But that is where you ask your questions. And if you want to go to it, my invite link is in the FAQs on nononsenseforex.com. I keep it a little bit hidden just so we don't get a flood of useless people in there. But that is where you go, and you can go to the investment forums and talk to us there and discuss ideas. And it's great. Like I said, sometimes it's active, sometimes it's a bit dead. But I can tell you from my end, this market often has a lot of things to talk about, and then sometimes it just doesn't, which is why I go back to this. You never cannibalize future episodes. So for those of you who might have asked a question like that and I don't get to it, sorry, but there is a reason. You will get a very detailed answer to your question in the future. So I have no idea how long this will actually take, so let's go ahead and get to it now. Go over to Discord, and the first question is, there's been a lot of good conversations on the server over the past few months about trading a smaller portfolio of markets that are more likely to trend. Bitcoin, gold, NASDAQ, oil, and maybe a single yen pair, all with the same system. What's your take? My take is I don't completely understand your question. I feel like I kind of do. You feel like there's markets out there that trend more than others. Oil usually doesn't. It is now. Yeah, I mean, you can use the same system if you're talking about technical analysis, yes, all across the board. It's good for pretty much everything. I said last episode that I don't recommend it for most crypto, really even Bitcoin right now, because it just moves too fast. If you guys don't know, we like to use the monthly chart here. There's been an entire episode on that. You can run a simple search in your podcast player or on YouTube, and it should pop up. But that really is the key to our success here, that combined with the no-nonsense Forex system of trading, which is also good for investing. So yeah, if you're using all the same system, I would say go right ahead. Just maybe don't do it with crypto until we see a lot more liquidity in the market. Bitcoin will be the first one to become tradable on the monthly chart. I just don't personally think it's there yet. But the rest of it, yeah, green light, go. Let's move on to the next one. I would like to know, what are your thoughts as when choosing the right blockchain as my method of payment? Well, I would need a bit more information there. What is the payment before, I would say right now, if you just want a broad answer, my answer is going to be the Ethereum chain. The Ethereum chain is not super expensive like it was in the past. Believe it or not, these things do improve. Solana breaks down less than it used to, and Ethereum is not as slow and expensive as it used to be. I can say just personally, in the last month and a half or so, I've moved a couple $100, and that cost about 38 cents. I moved a couple $1,000. That cost like a little bit more, like 70, 80 cents, which was awesome. And then I bought more Chainlink back when it was around like $13. And all these transactions not only were fast, but they were super cheap. So instead of pigeonholing yourself into a blockchain that the people on the other side of the transaction may not be using, you really can't go wrong right now with just using Ethereum. And then over time, we'll see the kind of the cream rise to the top and a lot more use cases for these other chains. But you guys know at this point in the crypto market, these things just take a lot more time than we want them to take. So in the meantime, I think Ethereum is the way to go. I think some people have this desire to use some of these other chains because they're new and exciting and you want to, get kind of a feel for them. But if it's going to result in you missing out on certain tokens or you ending up with tokens that have a lot of liquidity on Ethereum but just don't have a whole lot on the chain you're on, then I don't think it's really worth it, especially when all the chains right now are pretty quick and pretty cheap. But again, it's a case-specific type thing. If you're making dozens of transactions a day and those little cents here and there might add up, well then sure. But for most people, I would say for now, Ethereum is absolutely the quickest, easiest, most convenient, less hassle way to travel. Next one. Oh, good one here. Have you ever considered using covered calls or any other hedge for your portfolio? Okay. So I don't mess with covered calls and things like yield max. They are very exciting, but they are also very untested. And the few times they have been able to measure these covered call ETFs and funds against their non-covered call counterpart, they underperform. It's kind of like the stupid gold to Bitcoin debate. Like if you cherry pick the time frame, you can make one look better than the other. But if you really kind of go long term, which is what we do here, they just don't stack up. And I want to see how they perform in a prolonged down market, like in a recession. If they can really show me that they can avoid getting completely creamed in a recession, which I think they're kind of set up to do between you and I, then I will change my mind. But we have so many good products out there that don't have that questionable mechanism to them that I just don't see the need to migrate over there, especially when options in general are something I understand less than I do other financial instruments and other ways of trading. It's just a big no for me, and I'm happy saying no, not because I'm against them, but because there's just really no need to go that direction. I'm not allured by the gains that they promise over short periods of time or by the hedging they claim to have. We'll see if that part's actually true when the market drops. But until then, there's a lot those things still need to show me, and they just haven't shown me yet. Next question. Kind of a curveball question. Totally understand if this is too off topic. I'd love to hear your thoughts on investing in building your own business versus investing in things like stocks, commodities, etc. Specifically, how you think the risk compares between the two, how you'd approach allocating capital between them, and what your own experience has been like when building your own businesses. Okay, so that's like 5 questions, but that's okay. I really like the question, so I will answer it in its entirety. Now, the first thing I can say is it really depends on, what's your business? How much experience do you have in it? What sector is it in? A lot of questions before you can really accurately answer a question like that. I will say this, however. If you are going to start a business, that is where almost all of your free money needs to go towards. Now, obviously, you need to pay bills and debt and stuff like that. But You don't, if you're going to have X amount of money to invest and you're going to start a business, almost all of it needs to go there. Now, you may not spend all of it on your business. It just depends on how much money, how much capital your business requires. You can invest the rest of it, but if you're going to go that route, you need to prioritize your business first. Absolutely. Because at the end of the day, that's going to be your biggest moneymaker. Investments will not be, unless they're just doing amazing. But once you have that business up and running and you start making profits, then you invest those profits. There's still a lot of people out there that they make profits and they keep them in cash, and that doesn't make any sense. Now, I have cash, but 90% of that cash is earning yield. It's not just sitting there getting gobbled up by inflation for no reason. And as this is an investing podcast, and you guys know the things I invest in, I have my money there as well. I like putting my money in things that would seem to be safer during an economic downturn. But yeah, I'm kind of deviating from the question here. But yes, at the end of the day, step one, make money. And if that involves spending money on a business to make money, then yes, that needs to be your number one focus. And then once you start making profits and putting it in the bank, that is when everything else starts coming into play. Yes, you might miss out on some gains because you're starting a business, but what are you going to do? What's the alternative? I cannot recommend enough starting your own business and getting away from the daily grind and the 9 to 5. If you're ever going to do half the things we talk about on this show when it comes to removing yourself from the system and living the life you want, you're going to have your own business. You're going to have to do things beyond trading and investing. Trading and investing need to be a part of it, but having your own business is vitally important. And you can't sit there and prolong that process just because you want to sink some more money into Solana. Wrong approach. Get that business up and moving. Get it profitable. Priority number one. Next question. Hi, VP. Could you go into detail about how you use the index that you shared on Twitter a few weeks ago for investing? So what he's referring to is I shared in return for some really nice affiliate link clicks on the Fold app. Thank you all for that. The response was overwhelming. You pushed me way to the front of the line on those link clicks. I said that I would share with you an index that I like to use and chart. And I'll just tell everybody right now, if you didn't catch that, if you go to TradingView and type in USDOLLAR, US dollar, you will get a dollar index that is equally weighted between the euro, the pound, the yen, and the Aussie. This is superior, in my opinion, to the DXY, which is like 50-something percent euro, 13% yen, has a little Swedish krona in there. It's kind of a mess. Now, this US dollar index I like a lot better. And the main use case that I have for it is the episode called Trade Your Own Money or Trade Real Life Forex. I can't remember what it was called. You guys know what it was, though. If you're searching for it, type in Trade Your Money, and I think it should pop up. That is the main use case I have for it. So what I do is the cash I do have on hand. Sometimes the dollar is not always the strongest currency out there, and I want to divest into other currencies. So I have to ask the question, okay, on the monthly chart, which ones are getting stronger? Where should those dollars go? And then once that question is answered, and the US dollar index helps me with that, then I allocate some funds over there. And then there's another episode called the Tack-On Method, TACK-ON method, to where, if I'm going to maybe make a 4 or 5% return on this little Forex trade I just made, why not make 8 or 9% by taking that money, let's say it's pounds in this case, and turning them into UK gilts? Now, I can do that because I have an offshore bank account that allows me to. Most Americans can't do that. So it's this whole system that I use to maximize the cash that I have on hand. Again, instead of letting it sit there and take a minus 3% or a minus 4% every year, I get more of a plus 6, plus 7, or else I aim for that. Some years are going to be better than others, of course. But that is the strategy I employ, and the US dollar index is one of the tools I use for that strategy. Okay, that question I answered on the forum itself. Next one, I can't remember the episode, but is in the Trading Psychology series. I don't remember the exact words, but Rob said that investing is holding a position for years, more than a decade. That's why I don't use charts for investing. Using the monthly charts is trading, in my opinion. Maybe VP remembers the episode number or name. Okay, so if you guys don't know, I have another podcast called the Trading Psychology Podcast, and we had an investing episode on it. It was one of the very few investing episodes I think we did because we want to keep that show about trading mostly. So my answer is, well, that's Rob's method. Yeah, I would like to hold things for that long, but it's not necessary that you do that. If your monthly chart is telling you that it might be going down for a while, then by all means, get rid of it if you want to. Now, with certain things, especially crypto, I like to buy and hold for a very long time, especially because, like I just said, that monthly chart may not do you right when it comes to timing. But I have let go of oil positions and uranium positions because my monthly chart told me to, and I was certainly better off for it. Like I said, there's no reason to stay in positions and hold forever when you don't have to, and you have charts that can tell you when it's an okay time to exit. That's what separates us from most, buy and hold forever retiree investors. And from a lot of financial planners that just keep their poor clients in these dying positions forever and just sit there and hope that they'll come back to life. Now, a lot of times they do, but you didn't have to sit there and go through all that turmoil if you didn't want to. So buy and hold forever is definitely a strategy, and it's shown to have been a good strategy. And honestly, contrarians going forward, I'm not sure how great of a strategy that's going to be in the future. We may have peaked in terms of just unbridled prosperity, but let's say I'm wrong on that. It's still better off to not take those losses for no reason. And when you have technical analysis the way we do, we have the unique luxury of not having to take all of those losses. So that's why we do it. If you guys remember an episode called The Rule of 72, you guys see, if you add little tiny percentage points to your overall yearly return, what a difference that can make. Compounding is magic, and the Rule of 72 illustrates this better than anything. So I am aiming for as many of those little percentage points as I can, and I'm not going to be able to get as many as I want if I just sit there like a ding-dong and take losses for no reason when my chart is screaming at me to sell. So that is my opinion on it. It is certainly not the majority's opinion in the investing world, but that's why this is the 10-Minute Contrarian Podcast now, isn't it? And that's why we win as often as we do. All right, one final question. I think this is a good one to end it on. The question is, with the West slowing in population growth, digital money, energy demand, and ecosystems like the metaverse, where are we looking when it comes to AI and robotics after all this hype? These clueless leaders claim that automation will save the day. That means they have to throw tons of money at it. Yeah, so my thoughts here are kind of the same thoughts with outsourcing. If you guys remember when outsourcing was a really, really big thing, you guys remember the day when they outsourced customer service out of your country and into a country that was a lot less helpful. Well, they did this with a lot of things. And that's why now in the United States, everybody who lives in a small town is pretty much on drugs now. It's really sad, and you should never do it. But you can't progress without it. It's a necessary evil, unfortunately. And corporations get blamed for it, but look, man, it's like if you decide not to do it, but your competition decides to do it, you're going to die. And you're going to collapse, and all of your employees will no longer have jobs. So yes, the number of robots are just going to keep increasing, and AI is going to play a much bigger part, and it's going to replace humans in a lot of ways. But that's just how it's going to go. I mean, maybe a place like Europe, who has always shunned technology, will be the exception here. Who knows? But how do we play that? Well, there's two things I want to mention here. One is something Raoul Paul has said, and I've heard variations of this from other places too. It's like, look, man, you probably got another 5 or 6 years to make as much money as possible. And then all of these things that the person who asked the question just mentioned, population decline, robotics, AI, is really going to start coming together and being a major component of how everyday life is going to go for most people, especially in the West. So, what are the solutions here? I guess that's the big one. Well, first of all, what we do, because I don't know much about these robotics companies. Some of them are here today, gone tomorrow. Some of them get really big contracts. Some of them will be getting really big contracts into the future. That's a whole sector I don't know much about. So what we normally do here on the show, our ethos, the path we normally take with this, is we like to invest in the things those robots simply cannot do without. And that's going to be certain metals, and that's going to be energy. And the same goes for AI. When AI first came out, well, actually when ChatGPT first came out, none of those versions of what was around back then are really around now. They've improved so much in such a short amount of time. How do you possibly invest in something like this? What you do is you invest in the things they will all need. And that's why NVIDIA did as well as it did. But people don't often look one level further down from NVIDIA. AI needs semiconductors to run, but what do the semiconductors need? And that's where we come in. Not to mention AI is going to take a ton of energy, gobs of energy, to run at full capacity. It already does. And that's why a lot of these Western nations who are doing things right, China, the United States, they're trying to position themselves to make sure they never have a shortage of these metals or a shortage of cheap energy. This is exactly why I try to position myself as well as I can, even if these things aren't moving the way I want them to. And this is why I prefer our method so much more than I do the conventional method of sitting here trying to pick the winners in the robotics and AI space. You just invest in the things they can't do without. That's much easier. We know what those things are. So many of these speculators are trying to find a needle in a haystack when we're just trying to find the haystack. And we know where the haystack is. It's right there. It's silver. It's copper. It's rare earths. It's energy. That's the game. But there are three major ways, in my opinion, to hedge against all of this. One is what we just talked about. Invest in things they will all need so you can make a bunch of money. So two, you can make as much money as you can before this, what Raoul calls the economic singularity, starts to take shape, assuming it does. And then three, something else you can do is a nice little extra credit bonus point, is live in a place or have full access to a place where a lot of this stuff's not going to matter. You think Paraguay is going to be worrying about AI and robotics anytime soon? In our lifetime? You think they're ever going to have to worry about a central bank digital currency? They still use cash for most transactions out there. It's great. And I have temporary residence there, and in a year I will have permanent residence there. And on top of that, I will have a business there with a bank account there. So step one, know what's coming and take advantage of it. Step two, make as much money as you can before it affects you. Three, just flat out make it not affect you. I mean, if you're in the collapsing West and you're worried about what's going to happen in the West 5 or 6 years from now, and you're not doing anything to remove yourself from the problem, because there will come a time when everybody wants to do it. And by then it will be way too late. Every country I have gotten residence in is now harder and or more expensive to get than it was when I got it. In some cases, like Panama, it's way more expensive. I just couldn't imagine doing what most people in the West are invariably going to do and sit there and see what's coming and not only dislike it, but still turn around, bend over, spread their cheeks, and wait for this thing to enter them. Not only will I not be doing that, I'm going to do my best to profit off of it as well. But that is another conversation for another time. And that other time, if all goes according to schedule, is going to be next week. So get ready for next week's episode. It's going to be an absolute banger. Thank you, everybody, for your questions. I know on YouTube there's probably going to be additional questions in the comment section. I'm going to refrain from answering them for now, but maybe the community will answer them for you. So don't be afraid to ask questions. But I hope episode 204 was informative and you enjoyed it. And I will try to do episodes like this a bit more often than once every 100 episodes or so. But we certainly need to get back to the world of financial prepping, because that is what we do here. Because understand that guy who's bent over with his cheeks spread just waiting for the inevitable is going to think you're absolutely crazy for doing any of the things we do on this podcast. But you know by now that you're not crazy. You're just early.